I think one of the major things that we have seen in the last couple of years is this whole geopolitical shifts and tensions, which has resulted in a complete reshaping of supply chains globally. And that has had implications for the way many multinational corporations manage their whole regional treasury centers and where you procure from, right? So I think that has been one major shift, which has had some implications for treasury, trade, and other businesses that banks typically offer.
Hi, I'm Nilanshuk. I'm responsible for partnerships at Nucleus. And Reet, welcome to the show. Do you want to introduce yourself in a couple of lines?
Sure, Nilangshut. Thank you very much for having me. My name is Reet. I'm a partner with EY Parthenon in Singapore, focused on financial services.
Great. So let's start at a high level. And when you look at corporate and SME banks in Asia Pacific, what are the three most important structural shifts happening today, which was not there 5 years ago?
So there's a few things happening, some which are very, very here and now, and some which are a little longer term. I think one of the major things that we have seen in the last couple of years is this whole geopolitical shifts and tensions, which has resulted in a complete reshaping of supply chains globally. And that has had implications for the way many multinational corporations manage their whole regional treasury centers and where you procure from, right? So I think that has been one major shift, which has had some implications for treasury, trade, and other businesses that banks typically offer. I think the second one, which is a bit more of an emerging trend, it's not as here and now, but it is something that will definitely reshape the landscape in 5 years and has a lot of economic implications for banks, is this emergence of stablecoins, right? And essentially what stablecoins promise is the ability to move funds almost instantaneously at very, very low cost. So the aspiration which people have already sort of achieved is less than a cent and less than a second for money movement globally. And if that is actually achieved at scale, and it will take some time because there's a lot of regulatory, there's a lack of harmony in regulations across markets. But if at some stage that becomes mainstream, then banks will lose a big chunk of their float income. And they will then have to think about how they recover that money from elsewhere. And look, the third trend, I wasn't planning to use this, but it's impossible to avoid, is, of course, I think the emergence of AI, which is changing the way banks can serve their customers and also changing the way that corporates can actually sort of deal with banks and how they deal with different banks.
Great. So among the three, you mentioned geopolitics, stablecoins, and AI. Which one would you think would disrupt the most and in a most pronounced manner if you look at the next few years?
I think it depends on the time horizon. If we take a 3-year horizon, of course, I think the technology piece, the whole digitization, AI would be a bit more disruptive. I think to an extent, the disruption related to geopolitics has already happened. And if I were to take a 10-year view, I would definitely say stablecoins. Yeah.
AI, as we know, uses and needs a huge amount of data, and there's a proliferation of data these days. When you look at from the transaction banking point of view, how do you see banks and the wider ecosystem using data and AI today?
So I think there's been a lot of use cases, a lot of POCs, and we've started to see some early cases of at scale go live kind of AI use cases that banks have adopted. So I think one major use case has been in the whole AML KYC space. So particularly for any payment flows and trade flows, the checking that you do and the screening that you do, and making sure that a lot of the manual part of that process that gets largely automated. So that is, of course, one use case. We've seen some work done around dynamic pricing, right? So earlier, of course, you had a huge amount of data across different transactions and different client counterparts, different ratings, different corridors. But pricing was typically negotiated bilaterally. But now, because of all the data that exists, and now you have the ability to analyze the data very quickly, so you're able to offer a much more dynamic pricing for specific transactions, right? Which you're really equipping your front office with. So that becomes, I think, a second use case. And I think a third use case is really around front office productivity. So when you talk about going to meet a customer, right? In the earlier days, a lot of it was dependent on the experience of the transaction banking salesperson. So they would really sort of have to read up different articles. They would have to understand what's going on in the company. They would have to understand trade flows. But there are banks today which have already built these AI solutions for the front office. It's like a sales cockpit, you know? And what you do is you just type in a query saying, hey, I'm going to meet client XX on product YY. So what should I talk about? And then this particular engine will scan newspaper headlines, it'll scan information about the company, it'll scan trends in whatever product you're talking about, whether it's a cash product or a trade product or an FX product. And it'll then generate a nice script that you can talk about these 3 points when you go to meet the customer. And that dramatically improves the productivity of the salesperson, both in terms of time saved in preparing for meetings and the quality of the conversation itself. So these are all use cases. And look, I could go on, but there's many of these that are actually already in place.
Absolutely. And we are also seeing an explosion of embedded finance and platform flows. So when you look at marketplaces, supply chain platforms, e-commerce ecosystems,
Yes.
what model shifts are required to adjust to the new reality, given these different ecosystems that are coming into play today?
Right. So I think this one is a good question. I think what banks have typically tried to do is they have tried to take a bit more of an ecosystem specific approach and try to be a bit more sector specialized, so to speak. So we have seen banks that have developed solutions geared around healthcare. So, for example, in healthcare in many markets, it's a major pain point for hospitals is around reconciliation of payments. Because you have a customer, the customer might choose to pay, he might have some co-payment. So he pays a part in cash and the rest is reimbursed by insurance. He might be totally cashless. He might be sort of paying partly, paying the whole thing in card, or he might opt for an installment plan, right? So there are multiple ways that a customer can pay. And then the hospital has to allocate the customer's total payment to different departments. So there might be a payment that needs to go to radiology. There might be a payment that goes to a specialist, a payment that goes to a surgeon, and so on. So that whole tracking of cash and then dispersing of that cash which is received is a huge pain point for hospitals. It's the number one pain point. And there are players that have specifically managed to solve this. And they have invested in specialized kind of solutions, typically starting with the POS and the whole finance and accounting system and enabling hospitals to receive those payments. And once you are able to crack this, then you default become the collections account and payment account for the hospital, which is a very lucrative source of float in cash management. So typically in this space, I think what we've seen is investing in specialized sort of solutions. And some banks in the region have also actually gone a step further. They have hired industry professionals. Last year I was working with a local bank in the Philippines, and they actually had two people they had hired. One was a former finance head of a hospital that had retired, and he had come on board as an advisor. And similarly, there was a retired CFO of an FMCG company who also came on board as an FMCG advisor. So how do you sort of understand the pain points of FMCGs and suppliers and distributors? And how do you therefore serve these customers more effectively? So that's, an interesting approach that many banks are taking to go after these ecosystems. Having said that, it's very difficult for one bank to systematically go after multiple sort of ecosystems. So you want to pick your bets, particularly if you're a local bank and you don't have that global scale to build some of these solutions.
Very intriguing. And to conclude, if you look at the next 2 to 3 years, where should decision makers place their bets? And once they make those bets, what are the kind of KPIs or metrics from a transaction banking lens that they should look at
Okay.
to measure their success?
Okay. That's a great question. I think it really depends on who you are, right? And if you take different roles, so one is obviously if I'm a head of corporate banking versus a head of SME banking, right? The outlook would be quite different and what I'd focus on would be different. And similarly, if I'm in charge of, let's say, a local bank versus an international bank, which could be regional or global, then the focus would be slightly different. So let's start with the sort of a regional/global head of corporate banking. from their perspective, obviously, there's one big concern around geopolitics, shifting supply chains, and, their evolving client needs, right? So their clients will potentially need to onboard new suppliers and distributors. They will need to establish new lines of credit. The risk profile of the company might have changed. For example, a company which was earlier heavily dependent on China and procuring at a certain price, now maybe they have to diversify their procurement and their pricing might not be as competitive. So it really becomes quite critical to take a whole new look at the working capital risk associated with these companies and trying to see if, trying to see what the implications are as a result of this whole geopolitical shift. And the other angle, obviously, for international banks is that, trade finance has been very much a bread and butter business for a long time. That business increasingly is, the fee component of that business is almost completely become quite negligible because especially as open account becomes more prevalent and then you start seeing stablecoins introduced into the mix for money movement, then you really see that this whole letter of credit business, the correspondent banking business, a lot of that really start to gradually fade to the side. In fact, Latin America is one example where we are seeing large corporates actually use stablecoin to very rapidly pay many smaller sort of suppliers who don't want to go through the full banking system, particularly if the payment is coming from somewhere like a China or some other part of the world. So we are seeing these kinds of trends, and that will be from the perspective of a large corporate focused banker. And the other extreme would be, let's take a local bank and a local bank looking at SMEs. I think here, depending on the type of market, I mean, obviously not a market like Singapore or Hong Kong, which is very well penetrated, but in many emerging markets, there's one big challenge around serving these SMEs because the quality of financials is very, very bad, right? And therefore, you cannot really understand the business of these customers. You cannot figure out what is the right way to lend to these customers, what's the funding they need, and how do you manage the risk. And we've seen a couple of approaches, both of which would be top of mind for a head of SME. One would be around how do I really penetrate supply chains? And there is an approach which has emerged from China called deep tier supply chain financing, which is you have an anchor corporate which is procuring from multiple suppliers, but those suppliers have sub-suppliers who also need financing. And many of them might be quite small, right? And those suppliers might have further upstream suppliers. So there are banks that have been working to try to penetrate the entire end-to-end supply chain. And the initial genesis of this was not really financing. It was to understand the total emissions. So for example, for a player like Walmart, right, they want to understand the emissions that they are generating. And they found 90% of their emissions were coming from raw materials. So to figure out their emissions, they had to understand the emissions all along the supply chain, which is why they had to map this out. And in the process of mapping this out, they then figured that they could offer a deep tier type supply chain financing solution so that there was adequate liquidity available across the chain. And this requires some specialized solutions, which of course have been built. There are a few successful examples of banks that have managed to implement this. I think the other thing to explore if you're an SME head, if you don't want to go down the supply chain financing route, is using alternative data to get a better sense of what can be done. So we have seen banks rely on telco data, utility bill data, bank statements, and using that to get a better picture of the customer and really then see what the real financials are and how do you then underwrite the customer. Because in SMEs, frequently in this part of the world, a lot of these are single owner businesses. And the willingness to repay of a customer is linked to the credit worthiness and the credit behavior of the owner. And if you have a sense of the owner, you can actually then get a good sense of whether this company is going to repay it. And if you look at telco data, the amount of telco data that that telco players have is quite scary. And we have seen examples of banks working with telcos to come up with an internal credit score, right? And a simple example, in an emerging market, we saw the telco can actually look at the location of a customer and see the behavior. So is he leaving home at the same time every day and going to an office and coming back at the same time every day? Or is the location behavior much more erratic, that they go some days of the week, they don't go at the same time? So you then get a sense of whether this person has a stable kind of job or it's much more dynamic. Then you get a sense of the browsing time. is the person browsing very late at night, or is the person actually get normal sleeping hours? So you get a sense of the quality of sleep, right? Uh, you're not supposed to be able to read the SMSs that are received by a person, but what you are able to do, and it's a bit borderline, is you can scan for keywords. So you can actually read all the SMSs that a person is getting, and you can search for the word overdue. And if the word overdue is there, you get a red flag saying, hey, this guy is potentially at risk. You can see the roaming history. So if a person has traveled abroad, you can potentially argue, hey, if this guy can afford to go to London or Singapore or wherever, he's probably a slightly better credit risk because he clearly has some savings and money saved up. So there's a number of these alternative data sources that people are using to get a better sense of clients and underwriting.
Reet, that's very informative and insightful.
Sure.
And I learned a lot, and I'm sure our viewers will as well. So thanks a lot for your time.
Thank you, Niranjan. Thanks for having me. Thank you.